Hi everybody, welcome back to Chapter 5. In this video, we'll begin our discussion of Part B of the chapter, Basic Annuities. An annuity is a series of cash flows of the same amount received or paid each period. Examples include a loan on which interest is paid in equal amounts, or a lease paid in equal installments during a specified period of time. So now you know the definition of an annuity. We also need to determine whether it is an ordinary annuity or an annuity due. In an ordinary annuity, the cash flow occurs at the end of each period, whereas in an annuity due, the cash flow occurs at the beginning of each period. That's really important to know. Example for an ordinary annuity. An installment note payable dated December 31st, 2021 might require the debtor to make 3 equal annual payments, with the first payment due on December 31st, 2022, and the last one due on December 31st, 2024. As you can see, each payment is made at the end of the compounding period, so that is an ordinary annuity. An example of an annuity due is a 3-year lease on a building that begins on December 31st, 2021 and ends on December 31st, 2024, may require the first year's lease payment in advance on December 31st, 2021. The third and last payment would take place on December 31st, 2023, the beginning of the third year. As you can see, each payment is due at the beginning of the compounding period, and therefore it is referred to as an annuity due. Here's a problem for you to work. Please pause your video to consider which is the correct answer to the following question. If you have a set of present value tables, an annual interest rate, the dollar amount of equal payments made, and the number of semi-annual payments, what other information do you need to calculate the present value of a series of payments? Did you choose option A? The timing of the payments, whether they are at the beginning or the end of the period, is crucial to know. You simply cannot calculate a present value or a future value accurately unless you know that. Before we go on to the next slide, I'd like us to take a look at the 6 future value and present value tables shown in the back of your textbook. I've got them flipped on their sides so you can read this section right here. This is table number 1, future value of $1. If you read what it says up here, it is used to calculate the future value of a single amount. The next table, table number 2, present value of $1, that table is used to calculate the present value of any single amount. Table number 3 is the future value of an ordinary annuity. And that table is used to calculate the future value of any series of equal payments made at the end of a computing period or compounding period. Table 4, present value of an ordinary annuity. If you look up to the top here, it says that you should use Table 4 to calculate the present value of any series of payments made at the end of an compounding period. Moving on to Table 5. Table 5 is the future value of an annuity due. And that table is used to calculate the future value of any series of equal payments made at the beginning of each compounding period. And the last table, table number 6, present value of an annuity due. That table is used to calculate the present value of any series of equal payments made at the beginning of a compounding period. So I took the time to show you this so that you can remember which table to use when you're working these problems. You get the table wrong, you've got the answer wrong. So you must select the correct table. Another problem for you, please pause your video and consider this question and select what you think is the correct answer. Then start your video again and check to see if you had the right answer. The Not Worth Getting Consulting Company purchased a machine for $15,000 down and $500 a month, payable at the end of the next 36 months. How would the company calculate the cash price of the machine, assuming that the interest rate is known? Well, if the payments are made at the end of each of the next 36 months, then we have a situation where we have an ordinary annuity. So D is the correct answer, $15,000 plus the present value of an ordinary annuity of $500 for 36 periods. And here's the theory behind that answer. So that's all for this video. When we come back in video lecture 5-4, we'll begin talking about future value of annuities.